our first monetary policy meeting and first monetary policy press conference post our new strategy. And if you remember, in our new strategy, we committed to adopt a communication tools and a communication policy that would be more approachable, easier to understand. And although clearly we need to capture all the elements that you are used to, we tried to do that in a more palatable and easier to understand way. So don't be surprised if it is slightly different from what you were accustomed to, and I hope that you will not mind if it is a bit more simple and structured in a slightly different way. So let's begin. So, good afternoon. The Vice President and myself welcome you to our press conference. At today's meeting, the Governing Council focused on two main topics. First, the implications of our strategy review for our forward guidance on the key ECB interest rates. And second, our assessment of the economy and our pandemic measures. In our recent strategy review, we agreed a symmetric inflation target of 2% over the medium term. Our policy rates have been close to their lower bound for some time, and the medium-term outlook for inflation is still well below our target. In these conditions, the Governing Council today revised its forward guidance on interest rates. We did so to underline our commitment to maintain a persistently accommodative monetary policy stance to meet our inflation target. In support of our symmetric 2% inflation target and in line with our monetary policy strategy, the Governing Council expects the key ECB interest rates to remain at their present or lower levels until we see inflation reaching 2% well ahead of the end of our projection horizon and durably for the rest of the projection horizon. And we judge that realized progress in underlying inflation is sufficiently advanced to be consistent with inflation stabilizing at 2% over the medium term. This may also imply a transitory period in which inflation is moderately above target. Let me now turn to the assessment of the economic outlook and our pandemic measures. The recovery in the euro area economy is on track. More and more people are getting vaccinated, and lockdown restrictions have been eased in most euro area countries. But the pandemic continues to cast a shadow, especially as the Delta variant constitutes a growing source of uncertainty. Inflation has picked up, although this increase is expected to be mostly temporary. The outlook for inflation over the medium term remains subdued. We need to preserve favorable financing conditions for all sectors of the economy over the pandemic period. This is essential for the current rebound to turn into a lasting expansion and to offset the negative impact of the pandemic on inflation. Therefore, having confirmed our June assessment of financing conditions and the inflation outlook, we continue to expect purchases under the Pandemic Emergency Programme, our PEP, over the current quarter to be conducted at a significantly higher pace than during the first months of the year. We also confirmed our other measures to support our price stability mandate, namely the level of the key ECB interest rates, our purchases under the Asset Purchase Programme, our reinvestment policies, and our longer-term refinancing operations, as all that is detailed in the press release published at 1:45 today. We stand ready to adjust all of our instruments as appropriate to ensure that inflation stabilizes at our 2% target over the medium term. I will now outline in more detail how we see the economy and inflation developing, and then talk about our assessment of financial and monetary conditions. So looking at the economic activity. The economy rebounded in the second quarter of the year, and as restrictions are eased, is on track for strong growth in the third quarter. We expect manufacturing to perform strongly, even though supply bottlenecks are holding back production in the near term. The reopening of large parts of the economy is supporting a vigorous bounce back in the services sector. But the Delta variant of the coronavirus could dampen this recovery in services, especially in tourism and hospitality. As people return to shops and restaurants and resume traveling, consumer spending is rising. Better job prospects, increasing confidence, and continued government support are reinforcing spending. The ongoing recovery in domestic and global demand is boosting optimism among businesses. This supports investments. For the first time since the start of the pandemic, our bank lending survey indicates that funding of fixed investment is an important factor driving the demand for loans to firms. We expect economic activity to return to its pre-crisis level in the first quarter of next year. But there is still a long way to go before the damage of the economy caused by the pandemic is offset. The number of people in job retention schemes has been declining, but remains high. Overall, there are still 3.3 million fewer people employed than before the pandemic, especially among the younger and lower skilled. Ambitious, targeted and coordinated fiscal policy should continue to complement monetary policy in supporting the recovery. In this context, the Next Generation EU programme has a key role to play. It will contribute to a stronger and uniform recovery across euro area countries. It will also accelerate the green and digital transitions and support necessary structural reforms that lift long-term growth. Let's look at inflation. Inflation was 1.9% in June. We expect inflation to increase further over the coming months and to decline again next year. The current increase in inflation is largely being driven by higher energy prices and by base effects from the sharp fall in oil prices at the start of the pandemic and the impact of the temporary VAT reduction in Germany last year. By early 2022, the impact of these factors should fade out as they fall out of the year-on-year inflation calculation. In the near term, the significant slack in the economy is holding back underlying inflationary pressures. Stronger demand and temporary cost pressures in the supply chain will put some upward pressure on prices. But weak wage growth and the past appreciation of the euro mean that price pressures will likely remain subdued for some time. There is still some way to go before the fallout from the pandemic on inflation is eliminated. As the economy recovers, supported by our monetary policy measures, we expect inflation to rise over the medium term, although remaining below our target. While measures of longer-term inflation expectations have increased, there remains some distance from our 2% target. Let us look at our risk assessment. We see the risks to the economic outlook as broadly balanced. Economic activity could outperform our expectations if consumers spend more than currently expected and draw more rapidly on their savings, those they have built up during the pandemic. A faster improvement in the pandemic situation could also lead to a stronger expansion than currently envisaged. But growth could underperform our expectations if the pandemic intensifies or if supply shortages turn out to be more persistent and hold back production. What about the financial and monetary conditions? Well, the recovery of growth and inflation still depends on favorable financing conditions. Market interest rates have declined since our last meeting. Financing conditions for most firms and households remain at favorable levels. Bank lending rates for firms and for households remain historically low. Firms are still well-funded as a result of their borrowing in the first wave of the pandemic, which in part explains why lending to firms has slowed. By contrast, lending to households is holding up. Our most recent bank lending survey shows that credit conditions for both firms and households have stabilized. Liquidity remains abundant. At the same time, the cost for firms of issuing equity is still high. Many firms and households have taken on more debt to weather the pandemic. Any worsening of the economy could therefore threaten their financial health, which could trickle through to the quality of banks' balance sheets. It remains essential to prevent balance sheet strains and tightening financing conditions from reinforcing each other. So, summing up, the euro area economy is rebounding strongly, but the outlook continues to depend on the course of the pandemic and progress with vaccinations. The current rise in inflation is expected to be largely temporary. Underlying price pressures will likely increase gradually, although leaving inflation over the medium term still well below our target. Our policy measures, including our revised forward guidance, will help the economy shift to a solid recovery and ultimately bring our inflation to our 2% target. Thank you very much. We're now ready to take your questions. Over to you, Wolfgang.
Thank you, President Lagarde. And today, the first question goes to Balazs Koranyi of Reuters. Balazs, please.
Good afternoon, and thanks for taking my question. President Lagarde, could you run me through your discussion on changing the forward guidance? We hear that you couldn't get unanimity on the guidance
here is that we accept the fact, this is what is meant by this may also imply, we accept the fact that inflation, that there will be moderate overshooting. And, moderation is a factor of judgment yet again. I'm not going to venture in any particular numerical assessment of what is moderate overshooting as opposed to excessive overshooting. I think what matters is that we accept it. We do not, it is incidental, it happens. We are not deliberately overshooting, but we recognize that the especially forceful or persistent policy decision that we make may imply moderate overshooting.
Thank you. And our list of questions is concluded by Larry Laird of May's News. So, Larry, please.
Thank you very much for taking my question, Madame Lagarde. Two questions, if you don't mind, and one is a bit of a follow-up, but you did discuss the lack of unanimity about the calibration of interest rates. Are you able to tell us what other opinions were expressed in those that you mentioned? The second question is you also made it very clear that it was the revision of forward guidance, particularly in regard to interest rates, that was up for discussion today. Does that not risk any kind of forward guidance on asset purchases, particularly as we are seeing other central banks beginning to discuss that with their own forward guidance? Does it put the ECB out of sync with other central banks?
On our meeting today, I'd like to just come back yet again to the fact that the framework and the key agreement that we have amongst ourselves is a unanimous agreement. As there was unanimous agreement around the fact that we had to develop forward guidance, adjust it to the new circumstances of the strategy, of the new strategy that we have, and making sure that it is operational. Now, where there was some divergence, as I said, minor divergence, but they are to be respected. I think I've been on record several times to say that it's perfectly fine that some might disagree. And if the disagreement is at the margin, as it was today, it reinforces the collective direction that we have discussed. But there was disagreement at the margin on the calibration, and then you go into the choice of words, and you can write all the articles in the world about this. But what is really important to me is total agreement and unanimity on the strategy review, and the agreement to disagree on the margin on the calibration of some aspects of the forward guidance. But it's not for me to sort of delve into that. I'm sure you're going to do your job and try to figure out who said what to whom and all the rest of it. We did revisit our forward guidance on interest rates of the ECB, and that's all that we discussed for the moment. So thank you very much. By the way, I would be very keen to hear from you whether this monetary policy statement is more palatable and not overly disturbing for those of you who are used to sort of identifying and redlining what word has changed here or there, because it's a significant change. But I'm very grateful that all members of staff have made the effort to make it clearer for all those who care to read it. Thank you so much, and for those of you who take a break, have a great break and stay safe.
Thank you very much. This concludes our press conference today. The next scheduled press conference is after the summer break on 9th of September. Until then, we all wish you a good break, restful vacation. Stay safe and healthy, and a good afternoon. Bye-bye.